Hey traders, welcome to the ultimate guide on maximizing your profits through smart money management. Whether you're a beginner or an experienced trader, I think there's something in this video for you. In the next few minutes, we'll cover why money management is crucial to success with option trading. We'll talk about how to size your positions, how to manage your positions, and diversify them, and we'll go through live trades on the option trading platform. In the next few minutes, we'll cover why money management is crucial to success with option trading. We'll talk about how to size your positions, how to manage your positions, and diversify them, and we'll go through live trades on the option trading platform. Be sure and hit that like and subscribe down below. Let's get this video to 100 likes. Also, be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. In options trading, risk management is not just important, it's essential. And here's why. Options are leveraged instruments magnifying both gains and losses. Market volatility can significantly impact option prices, leading to rapid fluctuations. And time decay erodes option value, especially as expiration approaches. Establishing the correct position, size, and risk reward is critical for options trading. We want to determine our risk tolerance based on our financial situation and goals. And for me, I have a separate options trading account that's separate from my 401k and retirement account, which I just kind of let move along as Fidelity and the S&P moves. And I want to use my position sizing to limit exposure on any single trade. So in a small account, I can go maybe 5% in a single trade, and in a large account, I like to keep it at 1 to 2% per trade per account. Remember, proper position sizing helps you to stay in the game when things don't go your way. Let's look at a live example. All right, guys, let's look at the position sizing in the stock ELF Beauty. First of all, what we're going to do is a put credit spread, because look at the chart. It's way down. The RSI is about in the middle, but year to date it's down. The fundamentals in ELF are great. Look at the financials, the revenue versus net income and the balance sheet, all very good. And so I want to go long. I want to place a put credit spread. So I'm going to be on the trade page. This is the Tasty Trade option trading platform. It's one of them that I use along with Moomoo. There's links down below for both, and benefits if you join through the link. So check those out. If you are not trading options on Tasty Trade or Moomoo, I suggest opening an account. They're both great. You can look at the table mode here. We punch in ELF right here, ELF in the upper left, and we're going to look at 26 days to expiration. I usually like to go 30 to 45, but right now the December looks pretty good. So we're going to be on the trade page, table mode. We open up December. I'm going to look at the 36 delta because it's down. I want to be pretty aggressive. So I'm going to go 120. I'm going to sell. So I'm going to puts are on the right, calls are on the left. I'm going to sell the 120 put right here in this first column. And then I'm going to buy the 110. So it's $10 wide. So because one option contract controls 100 shares, the amount that we're going to collect is not $3, it's really $300. So $300 is what is deposited in our account as soon as we hit review and send. And if we go to curve mode right here, you can see as long as we stay above this 120 put, and we're at 126 right now, we would have to drop down to 120. So down right about here in order for us to actually, we're profitable all the way down to 120 minus the $3, so down to 117 is our break even. So all the way down to 117. But if we stay above 120, we keep that full $300. Our max loss over here is $700 P&L at expiration. You can see right here, max loss. So that is the $10 width of the strikes between 120 and 110 minus the $3 credit. That's the max amount that we can lose, and you can see here on the chart. So we know our max loss. What we want to do when we talk about position sizing, because options are using leverage, this uses $700 in buying power. So if there's a big market drop, this money's gone. It's going to go down here. We're going to lose $700. So we want to be able to, we can roll it out, but if the market drops huge, then that can completely be lost. So what we want to do and not get too big. We want to have our buying power that we utilize be only about a third of what is in our account. That's what I like to use, 1/3 to 1/2 in a smaller account. If it's a large account, I like to keep it under a third or even less. So that's a little bit of the way to show position sizing on a put credit spread. We also want to consider adjusting our positions based upon our risk tolerance and our account size. So we implement volatility-based sizing for high volatile assets. So we can reduce our position sizes for more volatile options to maintain consistent risk levels. We also want to regularly reassess and adjust our position sizes as our account grows or shrinks to maintain our desired risk profile. We also want to balance out our options trading portfolio by utilizing different strategies. We want to combine long and short positions to offset potential losses and capitalize on various market movements. We want to diversify across multiple sectors, so healthcare, finance, tech, a lot of different sectors, oil maybe. We want to implement a mix of strategies such as covered calls and poor man's covered calls for income generation, protective puts for downside protection, strangles and iron condors for range-bound markets when we think a stock is going to trade within a range. And then we want to use puts and calls and credit spreads as well to be directionally biased and collect premium. So we want to adapt these strategies based on the current market conditions and what our outlook is, whether it's bullish or bearish. Now here's a quick example of another strategy in Micron, ticker symbol MU. And you can see this is down. I think it's a great long-term play. What I'm going to do is buy a leaps option. So go to the table mode, type in MU on the Tastytrade Trade platform. I'm going to go out here. Let's look at September 2025. So out 10 months, and we can buy the 90 call, which is the 70 delta, and the cost, the mid price is $24.75. So instead of paying $102 per share times 100 shares, is that would be $10,264 to control 100 shares. We're going to control it for $24.75 per share, or times 100 shares, $2,475. So almost just about a fourth of the cost, we're going to control the same number of shares. Now, if you go to the curve mode here, you can see that as the stock price increases, sure, it needs to get up to the 115, it needs to increase, but my target for Micron is 160, 170 over the next year. But it increases just like owning the stock outright. Now, one thing that we can do as well is, and if you look here, the max loss is the amount that we paid, so $2,475. So in some ways, these are safer than owning the stock because your max loss is much less. And your buying power effect, again, is that amount that you pay up front. That's the max you can lose. That's the max loss that you can incur. So when we talk about that third or half of your buying power, this would be that part of it. Now, we can also collect monthly income, poor man's covered call, and I've done videos on this. If we look at the December chain, we can sell a call. Calls are on the left, bid, sell, and we can sell the 110 call and collect $3.70. So you can see our price went down $20.97. We can collect that every month, or we could even go to the weekly options right here. Actually, let me clear that one, delete the leg, and then we'll go to the weeklies, all expirations, and I'm going to go out. We can go 5 days is next week. We can go the end of next week, and we can collect $1 if we go to the 105, and I'm going to go out 2 weeks. If we go out 12 days, because we've got earnings on 12/18, we can go out to 110 and collect $88. But yeah, I think in this case we're better off going to the regular option chain because it's after the December 18th. And I would go out to the 27 delta. We can go out to 115, so still collect a huge upside on the leaps. and we could collect $2.45. That's probably the trade I would place for 22.30 or 22.23, and that's our buying power effect. We hit review and send and place the trade. This is an example of another strategy. It's a long strategy. It's not neutral, so it's bullish, but you want to have a mix of strategies. We also want to manage our portfolio based upon historical trend lines and our outlook for the market, whether it's bullish or bearish. We want to understand our overall portfolio delta. If we're positive delta, then we have a bullish outlook. If we're neutral, our stance is market neutral. If we have a negative delta, then we are hoping that the market moves down, and we are bearish on the stock market. So we want to adjust our delta based on the historical trending average. In an uptrending market, we want to stay slightly positive delta, downtrending negative delta, and in a sideways, we want to pretty much aim for neutrality. So we want to regularly rebalance our portfolios to maintain the desired delta exposure as the market conditions change. By the way, if you guys want to receive the free options strategies trading guide covering all the different strategies as well as managing them, then comment options guide down below and I'll send you the link. Effectively managing winning trades is critical for options trading success. We want to determine realistic profit goals based upon the strategy that we implement and our expected profit goal, the historical volatility of the underlying asset, the time until expiration, and our risk tolerance. So if I have a big gain, for instance, in an iron condor, 50% right away in the first few days, I'll take that off and look for another trade. At the same time, if it hasn't moved yet too much, then I'll go ahead and let it run. We want to look at technical analysis as well in order to identify potential resistance levels and exit points. And then we want to maybe scale out as opposed to taking all the profits right at once. Sometimes I'll take a quick profit in one tranche, but if I've got another tranche on of the same trade, for instance, 2 contracts, I'll sell one and let the other run. The way that we handle our losing positions is critical as well. We want to define our exit strategies. We want to set predetermined exit points based on technical analysis or the percentage loss. Sometimes if I'm collecting $300, I don't want to take a max loss of more than $500 or $600. And we can also roll out. Once I get to the 10 to 20 days to expiration point, I'll roll to the next month if I want to stay in the trade. We can also utilize the options Greeks for risk assessment. Let me know down below in the comments if you want me to do a video outlining the Greeks in more detail. I'll give you a quick overview though right now. Delta measures the rate of change in option price relative to the underlying asset's price movement. We use delta to gauge directional risk and adjust our position sizes accordingly. Gamma indicates the rate of change in delta. I kind of think of it like acceleration. And theta represents time decay of the option value. And then vega, one that not too many people use, it measures the sensitivity to changes in implied volatility. Rho is another one. I can cover that, but again, nobody really uses Rho. All right, guys, be sure and download the free options workshop in the link below. Remember to hit like and subscribe. Leave a comment, ask a question. I answer everyone. Thanks for watching. I'll see you in the next video.